Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. The UK stock market has traded at a discount for years, unloved, overlooked, and undervalued. But amid all the negative sentiment, some sectors have quietly defied the gloom. Are we seeing the first green shoots for UK equity investors?
This week, we're joined by Ed Croft, co-founder of Stockopedia. We dig into what's working in the UK market, what's broken, and where the best opportunities might be. And in today's dumb question of the week, what is a value trap and how do you avoid falling into one? All right, let's get into it. So again, we're delighted to be joined by Ed Croft today, the founder of Stockopedia. And thanks so much for coming back on the podcast, Ed.
It's great to be here. We had a lot of fun last time, so thanks for having me again.
So let's start off at high-level terms here. I think it's pretty clear that by pretty much any metric you look at, the UK has traded at a discount to its global peers for a long time now. Ed, why do you think that valuation gap persists to this day?
Well, I think it really comes down to a range of factors. Obviously, Brexit didn't do us any good. Let's start there. I think we've seen about 9 years of outflows. I was reading a Calastone report and they track all the fund flows. And I think it's been 9 years of outflows from equity funds. So that really goes back right till the Brexit vote. And I think that's definitely been a reason or definitely an excuse for global fund managers and asset allocators to kind of allocate away from the UK. You know, that could really mask a much longer term issue in the UK market, which has really been going on for at least 2 or 3 decades. And a few things make the environment here like a sea change of allocation, even internally in the UK, away from UK equities. So pensions, there have been a whole range of factors in pensions as to why they've lowered their UK equity exposure. And you can only ever get mixed stats on this, but I think in the 90s, there was at least 40% exposure towards UK equities by pension funds. And that's really dropped to just a few percent now, I believe. And that's been a big sea change. And there were nudges on defined benefit schemes. And I don't pretend to be an expert on the pension environment. You guys might be better at this than me, but I do know that there's also been a lot of changes in defined contribution plans to more globally diversified funds. And these things have led to a bit of a sea shift away. And that's actually created a bit of a disparity in the kind of amount of equities that UK equities are owned relative to some of our European peers. So there are more domestic equities owned in France and Germany, as an example. And so that has definitely been one of the big shifts and why you've seen a lot of kind of outflows. But also, I think there are certain competitive factors around the UK market, such as stamp duty on local equities. It's that 0.5% drag. And a lot of companies now, they end up listing abroad as well. And it would lead to people thinking, well, why buy the shares on the UK market if I have to spend 0.5% on entry? And that makes it a bit less competitive. And there were also dividend tax credits were removed, I believe, Gordon Brown back in the 90s and things, which actually, again, has been a bit of a disincentive to invest in UK equities. So there are a whole load of those sorts of reasons which have led to there being lower ownership and really also pushing down valuations, which has been going on for so much time. And obviously the sector composition, I think, as well, is another sort of issue in the UK market. You don't really have as many growth stocks, growth sectors. The kind of exciting growth names that we might have had in the UK a few decades ago aren't really here as much. So, and obviously in America, we have huge tech companies and much more kind of dynamic economy. So a long story short, I think those are really the core reasons. But of course, I think when valuations get quite low, it does spring up quite a lot of opportunity for value investors. So it's not all bad.
I remember that Paul Marshall had a comment about the UK market. He said it was the Jurassic Park of stock exchanges, which I thought was a bit harsh. Now, I think his point was that when we have a stock, we expect it to pay dividends, whereas in the US, it's very much a growth story. Do you think that's a mistake, or is it just the nature of UK markets that we expect payouts and dividends and we don't get the kind of capital growthy type approach of the US?
Do I think it's a mistake? I think you're certainly seeing a bit of a sea change in the UK, and I don't have stats on this, but I see a lot of companies opting for buybacks now over dividends, which is when companies spend the money, the excess profit they have on buying their own shares in. So that is definitely one of the tools that companies use, which actually ends up reducing the number of shares in issue, which is quite good if you're an owner of the company, because it means that the earnings that are proportional to your own stake are growing. And we've seen like companies like Next, which have had buyback programs for many, many years, and it really helps sort of drive the share price significantly higher. I think in terms of the fund management groups that there is a conservative bias definitely towards income shares and value shares. And it certainly seems like the market does reward dividends. When a company reinstates its dividend, often you see a whole swathe of new owners coming in and you see a bit of a jump. I'm trying to think of an example like McBride earlier in the year when it said it was reinstating the dividend. It had a huge pop on the day, 20% or so. So that even those sort of market indicators, they do show you that there is that sort of preference.
I mean, there are some funds that only buy high dividend paying stocks, right? So if you get included in those funds, presumably it gives you a tailwind as a company.
Exactly. And they've got a lot of capital and a lot of power in the market. And you certainly hear a lot that, and you see it a lot when there are growthy companies that are listed, we don't reward them. So we did a big study on IPOs in the UK market, and there were a lot of kind of more racy IPOs a few years back. And generally, they got away, they got listed, but then the share prices all sort of decline. And we even had one a few weeks ago, the Beauty Tech Group, rather a growthy stock, was like first reasonable, good sized IPO, 300 million IPO for quite a while that came onto the market. And it came on at a premium and it popped a little bit, but it sort of dipped down ever since the last couple of weeks. And that's another reason why so many companies will end up moving abroad, moving their listing abroad. They don't feel like they're getting the valuation they want. It's this sort of prudent conservatism of the UK asset management environment, I think, is quite negative to a lot of those kind of companies. So yeah, it is a problem.
So we started off on a bit of a negative footing, but let's take a positive spin here. What sectors have you seen that are actually doing quite well in the UK? We don't tend to talk about them a lot, but they are there.
They are there, and we have a national hobby of talking the UK down, and it really kind of winds me up. And I think we've got to appreciate many of the really strong companies that we do have here. I've been thinking about this all through the year because, it's quite a good year for the UK market. It's up. Well, I was looking at the weekend. It was up 16%. It was actually up more than the S&P.
Yeah.
And of course, if you put the dividends on top, it's outperforming. Some of the drivers of that, yes, I mean, defense is a big one. Rolls-Royce has had a stunning run. I think it's more than doubled in the last year. And, it's kind of gone from that being sort of perceived as a rather sort of debt-laden aerospace engine maker to kind of much more, it's powering data centers, it's powering defense, and it's gone on an enormous run. Babcock suddenly had a huge run earlier this year. And actually, a really good case study example is Goodwin, which is a sort of lesser known, more niche kind of cyclical industrial engineering firm. And they suddenly got a contract with Northrop Grumman, which is like one of the, big American firm. And it really sort of pivoted the way that the market perceives this company into being now a sort of defense contractor. And the sudden valuation spike's enormous. So definitely defense has been a great sector. Obviously gold, we've got quite a few gold miners listed in London, and the gold and silver prices have been on an absolute tear all year.
It's ridiculous, isn't it?
It's amazing. I've been a bit of a gold bull for a while, so it's good to see that thesis coming true. But a lot of the kind of runs in the junior gold miners have been quite stunning. Even the large caps are behaving like they're small caps now. And I think with energy costs being a bit low, the cost base has been kind of steady, whereas the gold price is shooting up. So it's all margin. But another sector that's really fascinated me, which of course, anyone speculating wouldn't really be in, is government contractors. There are many of these. And, after I think it was Contrarian back in 2018 that went bust, people have sort of shied away from that sector. But the whole sort of framework has changed now. You have very different bidding contracts. And with a government that's investing a lot in infrastructure and, road and rail and everything else around the country, so companies like Kier and Galliford Try, Morgan Sindall is a wonderful compounder. It has some exposure to government spending too. And these companies have been just beautiful, smooth trending businesses. So those are some of the themes I spotted.
I mean, just casting my eye over a kind of heat map, which we've got for our members, which breaks down the FTSE 350 and colours according to returns. The one that kind of really stands out to me is a really big sector in the UK, and that's financials.
Yeah.
So a lot of these banks, for example, have been doing really well. So I look at HSBC, Barclays, even Lloyd's is doing pretty well.
Yeah.
And Standard Chartered, I mean, maybe that's off a very low base a year ago, but that's kind of an interesting story as well, because you'd expect that to be cyclical, wouldn't you?
I know. Well, the whole financial sector has been one that we've been analysing a lot. And some of the real turning points amongst financials also include the wealth management firms. So the Jupiters and Polar Capital and fund management groups like that have really got to such long cyclical lows. And then the turnaround can be really quite quick. So I've been seeing quite a lot of sort of inflows into the fund management groups, which are potentially kind of highlighting a bit of a change in the UK. What's the inverse of a canary in the coal mine? I was going to say whatever the other way around is. But maybe a sort of a green light area there that's quite positive after so much negativity after so many years.
Even St James's Plate.
I know. After all the scandals. It's amazing. So, but that is the wonderful thing about investing. I was writing a piece the other day and analysing the fact that 3 to 5 year losers. So there's this idea of momentum. And 1 year losers you want to sort of avoid, okay? And 1 year winners you want to keep an eye on because winners tend to keep winning, losers tend to keep losing.
When you say 1 year winners and 1 year losers, do you mean how the stock price has moved over the course of the 12 months?
Exactly. We call this momentum. And generally, not in all market environments, but on average over the long term, the stocks that have done the best over the last 6 to 12 months on a look back, so if you literally just sort the market and pick the top 10% of shares that have done the best, they often go on and continue to do well. And that seems so counterintuitive. But about the financial sector, if you look at the kind of 3 to 5 year loser group, that is often a place where sectors turn around and they start coming back. And it's statistically and empirically kind of proven. And it's actually more powerful in terms of returns than even higher dividend yielding shares. So if you can find 1 year winning sectors, which were in the 3 to 5 year loser segments of the market, that can be a good place to fish. And that's one of the reasons why some of the financial areas have been really interesting. There have been lots of small lenders that have done very well in the last year. We're seeing lots of small cap lenders. IPF is one that's just being bid, International Personal Finance. There was ASA International, which does microloans all around the world. And as many of these smaller companies have really been doing very well. And actually, there's even like IPOs coming, big one, like Shawbrook is coming back to the market. And so, yes, and that's telling, isn't it? That the market is rewarding financials a bit more when they start listing again. So, yes, I should have mentioned it, but you're absolutely right.
Do you have to be a contrarian to invest in the UK market?
Do you have to be a contrarian? Well, I think you have to be, right now, you have to be somebody that likes value investing.
Yeah.
And you could say that value investors are always contrarians, or you could say they're just sane investors. If you look at America, you are just wowed by the names. You are wowed by the growth rates, but the valuations are off the scale. And I think the UK is at something, it depends how you look at it, but anywhere from a 30 to a 40% discount to the US. But the thing is, in America, I think 95 cents of every dollar invested under the age of 40 is rolling into index funds. And that is almost auto-invested regardless of valuation in great companies. Absolutely great companies, but it means that it's value agnostic investing. And those index funds investments are not really going into UK companies. So yes, I think, you do have to be a bit contrarian. You have to realize that buying cheap pays. It does tend to pay because Mr. Market does his work. It will bring those valuations back to sanity at some point.
Provided you're prepared to wait, I guess.
Well, that's why I like momentum, because if you can find cheap shares that are also doing well, trends tend to persist and value tends to mean revert. So you get that double whammy of both powers kind of in your favor. So I don't like buying shares that are too cheap. I think I like buying cheap shares when they are on the turn.
Yeah, don't try and pick the bottom. Let other people pick the bottom for you and then jump on the bandwagon.
Exactly, yeah.
My UK small caps have finally turned the corner. Can I say I'm finally beating the small cap index in the UK? So I'm overjoyed. But it was an accidental win because it was primarily because of these two gold mining companies, which were the materials sector, which I own as part of that. So I've got two from each sector, and it's value, quality, momentum driven based on Stockopedia's rankings, and
Yeah.
it's doing well. I mean, but it's always the case. When I do well, it's accidental.
Well, but that's actually, you dig into a really important fact here because, I've been running portfolios for a very long time, and the one that I publish publicly as a model portfolio on the site, it's 20 stocks, and it's always one or two shares that year, or one sector, or one particular name that will be the one that doubles and carries quite a lot of the outperformance. And you are often surprised. For me, it's the same thing. It's my gold shares that have done really, really well. And then you think, okay, maybe I got lucky. But then it's funny how you can feel like you got lucky every year if you keep putting your investments in towards the same sort of characteristics. It just happens that the gold shares were very undervalued, they had good trends, and there's a bit of a tailwind behind them. I look back and think, well, most investing success, it feels accidental, but it's purposeful because you can make your own luck. Putting a good process in place, and you should give yourself a round of applause for putting a good process in place. I don't think it's as accidental as you think.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
And if we look more broadly at the UK market, do you think we're seeing a genuine improvement in the fundamentals here? I know we've said it's off a low base, but could you see it continuing into 2026, 2027? Is this a market people want to be in?
Well, I think so. I've been tracking the UK market, obviously, for a very, very, very long time. And I was quite bearish for a while, but there was a sort of pivotal low some time ago on an indicator that I tracked. It was the worst reading there had been since the financial crisis, and second or third worst for more than 25 years. And, markets are quite cyclical. But that wasn't necessarily the time for me to get really bullish, because I like to see two really key things in any market. And this all came actually from an old book, which I read many, many moons ago, called Winning on Wall Street by a guy called Marty Zweig. And he had this great phrase, don't fight the tape, don't fight the Fed. And if I unpack that for you, it means when the markets are trending up, or when the tape is positive, that's a positive sign. So momentum is with you. And don't fight the Fed means if interest rates are coming down or they're going up, don't fight it. But then actually there is a third thing, which is if valuation is very low, that's also a positive. So for me, I think you've got three things, actually. We've got very cheap valuation. And I've analysed this against other international markets. And the UK is I think the FTSE All Shares on a P of about 14.5 looking back, 12 going forwards. And the S&P is on a P of 24 times on a backwards. This is the median price earnings ratios across the whole.
Yeah.
And the FTSE Euro First 300 is on a P of about 18. So the UK is on a 20% discount to Europe. It's on a 30% plus discount to America. So that valuation, it really puts a bit of a floor under it. We're seeing that with all the takeover bids and everything. People know it's cheap and there's a bid under the market. And then if you look at interest rates, they're coming down. They've been coming down from 5.25%. The last cut was in August, wasn't it? And then it's projected to come down to 3.5% in 2026 at some point. But they're staying a bit higher than was expected. But rates are coming down. And then the market's going up. So it's up 15, 16% year to date. And so you've got rising market, cheap valuation, interest rates coming down. Loads of things to be worried about.
Yeah.
Loads of things to be worried about. But I've been quite bullish on the UK as a result. So for me, yes, I think this trend will continue. I think there was also I think it was at a Bank of America report I saw recently, which said that international fund managers had their lowest exposure to the UK in decades or something. And so I think all of these things mean that it doesn't take much for things to shift. And if you look at smaller companies, they're even more underinvested in. So I think there's lots, if you like value investing and those three factors I said stand true, I think things could be okay. But of course, if America catches a cold and the market crashes because of AI or something like that, everyone's going to be affected. But that's just typical equity risk, I think.
We might be affected less, though. We've seen that happen before, haven't we? Like 2022, markets sold off everywhere. But the UK was not down that much.
Well, this is the thing. There's sort of lies, damn lies, and statistics. It's true that because the FTSE 100 has a lot of value names, it was already very cheap. The FTSE 100 was one of the most resilient international markets and indices. And there was a shift to value. That's sort of a similar thing to as we saw at the end of the dot-com era. You had a shift to value and value indices did better. But if you looked at small caps and the AIM market, there's a lot of dross on AIM, a lot of speculative companies, but also some brilliant companies. That fell by 45% or more between, I think, September 21 and the bottom about 3 years later. So I think, sometimes if you look at just only at the FTSE 100, it can mask action going on. So that risk-off sort of bearish trade was really impacting a lot of companies.
A 45% drop is a lot if you're just trying to swerve inheritance tax.
Yeah, it's brutal.
That's why anyone buys AIM, isn't it?
Yeah.
But I've got a question about what's going to happen with politics, because this isn't a political podcast, but we do obviously talk about the impact of politics on markets. And every party wants to stimulate growth. They have slightly different ways of doing it. But do you think that the economic backdrop at the moment is one which is conducive to a good performance in the equity market?
I think it's a very good question. I think some of the things that I always look at, and I'm always keeping an eye on, is how could politicians switch the equity markets back on, if you know what I mean? I do think that, okay, the consumer's taken a bit of a hit, taxes and national insurance, and that's all been quite a headwind. But there's a lot of government spending. GDP figures have been ticking up. People I know with consumer businesses are finding it really hard. I was in Devon at the weekend at a little hotel. It's been wonderful. It had a real boom in COVID. But then this year, he said, it's been his worst year in years. And I think that's the impact of people deferring spending and saving a bit more and feeling uncertain and feeling like they're going to get whacked by taxes. But of course, the government spending is still going on. The GDP figures are still there. So it's kind of a shift maybe in the weight of spending in the economy. I'm no macroeconomist, but I think that if some of that comes through, we're certainly seeing it in those government contractors, as I said. So internally in the market, there's always some sectors rotating and doing better and worse. But I think in terms of policy, I know, and I've been tracking for a long time because I'm biased because I have a business in this area. But in terms of some of the reforms that are being talked about, in terms of should we, as a nation, ring fence some capital, more capital, and encourage and incentivize it to invest in UK PLC, certainly that should happen. And whether the choices that Rachel Reeves might make on the British, on ISAs and nudging the amount in cash ISAs relative to equity ISAs, You can have people can argue about that sort of thing, but these are perhaps indications that the government is taking this a bit more seriously. There've been a lot of reviews. There's been the Mansion House reforms. The government have also commissioned entire studies on investment research environment, which has really taken a hit. And I think also just tilting taxes a little bit can make a huge difference in the UK market. So any pension incentives to invest more in UK PLC, these ideas of having these super funds or encouraging local pensions to invest more in the UK market, and perhaps scrapping stamp duty. I can't get all my Christmases at once, but these things would definitely help. And as far as I'm aware, there are also reforms that can be made on prospectuses and the regulatory environment around listing to try and encourage more IPOs. I mean, at least we've got some more IPOs coming in. I mean, there's been so much bad press about, there was only, I think, maybe only 9 issues year to date, only 180 million have been raised. And then we got this one I mentioned earlier, the Beauty Tech Group, which had 300 million. But we got a couple of big IPOs coming in the next week or so. So that's a positive. So I think, we can badmouth it all. These things are quite cyclical, and I think the UK is still a good place to do business. And I think that the politicians they've got the memo now.
So much of the noise I hear coming out of government, though, is around getting people into private equity and private assets. They seem to have taken their eye off listed markets a little bit, I think. Do you sense that?
It's very true. And I think I would say, don't get me started. I think that private equity has done and has been an enormously successful industry. And I would say at the moment, it's becoming quite constipated. They are really struggling to offload all the investments they have. And this is causing quite a lot of concern. And I think the fact that the government is even considering legislating to make pension funds own large swathes of private equity, I think is an indication that the private equity lobbying is being very successful. And I think there is a lot of obfuscation of the actual returns that are realized by private equity investors. And definitely back in the 80s and 90s, there were some amazing returns to these asset groups. But ultimately, it's just equity. And if the managers, private equity managers, are making very, very high yields, and also there's been such a flood of capital into the sector, they're all bidding on the same firms. The valuations of companies that are bought into private equity funds have more than doubled, maybe even tripled in the last 10 years. And so the future returns can never be as good. So I think that it has been a problem for public equity. But again, then, also, I don't mind if there are bids in the UK market. It's a way of indicating that shares are very cheap. It also puts a floor under the market and so on. But there's been a lot of delistings. There's 250 less companies on the UK market than there were 2 years ago. And that is a big problem. It's a net outflow like we've not seen in years and years. And that's companies delisting and going to America, or it's private equity bidding them out, or strategic buyers, acquisitions and so on. But I think that private equity, without healthy public equity markets, they've got a lot of problems. They can't, because they've got to realize returns for their investors, normally in a sort of 7-year window. And if they can't offload them to trade buyers or to IPO, and with a closed IPO market, that's a big problem for them.
Yeah, they have to get the government to write a bill to find the bag holders.
Exactly. So I definitely would say, look, if there are, and there have been some really good listed sort of private equity funds that have done very well, but I think one has to be quite careful if private investors are being sold to with new vehicles that come on the market in the next couple of years or 5 years, because I think you've got to think who is selling those to you and why.
And at what cost.
Yes.
I was at an event recently. I got to close the bell at the London Stock Exchange. I got one of these little bells.
Wow.
That was quite exciting. So I was very excited. Anyway, we had this brilliant talk from Julia Hoggett, who's the CEO of LSE, London Stock Exchange. And one of her points was that nowadays you could go into a local corner shop and buy cryptocurrency on like a card. But if you wanted to buy an IPO, I can still remember the Tell Sid advertisements in the UK where everyone was suddenly excited about buying stocks. But now nobody is excited about buying stocks, IPOs. So she was talking about how we can get back to that original feeling of excitement. So do you think that's the way to do it, with advertisements or government education?
I think you're so right. I think there's been so much has been put in the way of education about equity returns, the enormous warnings that are put on every investment that's equity related. And it's always, you're always having to see shares can go down, and are you really sure? And is this really risk for you? And there's risk warnings on everything. And no one puts a risk warning on cash. And cash is guaranteed to lose you money. It's guaranteed to inflate away. And I think if anybody's got a cash ISA, does it come with a massive warning? You will lose 3% plus a year, guaranteed.
Print it on the banknotes below the king's face.
Exactly. And you look at equities, and they're volatile. So of course, the problem is, in 1 year, if you need the money back, you should just have cash. I've made that mistake myself in the past, and losing money when I really needed it in the next 12 months. But if it's money you don't need for 5 years, you should not have that in cash. You should definitely be invested in equities. And I think the whole culture around this needs to be looked at. There's a lot of red tape that might need to go. You've got to protect people from scammers. You've got to protect people from Wolf of Wall Street type stuff. But we need to encourage risk-taking in this country. We've become far too conservative and far too prudent. And that feeds into everything, like young companies struggling to get any investment. And there've been some good schemes, and like EIS in the past, which have really helped small businesses to get investment. But I think the public equity markets, like the AIM market, was supposed to be a place where young companies could go and really seek growth capital. And now they're because the tap's been turned off in terms of the investment flows, they just go to private equity or venture capital instead. And it's a real shame. It's one of the reasons we don't see those growth stars that are listed anymore. But we've got them. We've got many great growth businesses in the UK. They're just not really on the public market. So yeah, I think it's definitely something we need to change. And I think it's a combination of incentives, it's education, it's reducing the regulatory burden, and so on. So hopefully that will happen.
Okay, last question just to wrap up then. It seems like we've discussed 1,000,001 sort of structural reasons why the UK markets have not done as well as they could have done, whether it's pensions shifting their asset allocation, or stamp duty, or sectoral composition, all this stuff. But if we believe that UK markets are undervalued and cheap relative to their global peers, shouldn't that be enough in the world of efficient markets and global capital? Why are rich people in America not saying, wow, look how cheap the UK is, I'm going to go and buy their companies? Although I guess they are, but they're taking them private.
I think they are, and I don't have the stats, but I've got the anecdotes. So I won't name the fund management group, but I know someone quite well in a fund management group, runs maybe 1.5 billion or so. And he was saying that basically the biggest ticket sizes were coming from America now. They had a £200 million ticket coming from a US family office. So you are definitely seeing strategic buyers coming over here and buying up UK businesses. You're seeing family offices coming over. And I think they're always at the front end of the curve. And I think that capital markets are rational and they are generally efficient. So I think the capital will come back. So I think it sort of is enough. And, to be honest, I don't want us to get people to be left with thinking that the UK is a bad place to invest. As I said, with low valuations, with strong momentum in the market, you can do very, very well in UK equities. And I've been doing this a long, long time, and you can beat the S&P 500 in UK shares if you know what you're doing. So it takes a little bit of effort. It's not as straightforward as buying a fund, and you would probably need to do it yourself. But those opportunities are out there. So, chin up, I would say.
The streets are paved with gold, and the gold price is up 50%.
Exactly.
So we've talked a lot about what's going on in markets. If you want to keep abreast of what's going on and you want something which is informative but amusing, then why not sign up for our free weekly market roundup? You can find out more by going to pensioncraft.com/newsletter.
Okay, today's dumb question of the week. What is a value trap, and how do you avoid falling into one?
Okay, a value trap is a company that looks really, really cheap. So as a value investor or a deep value investor, it's exactly the kind of company you're looking for. It's very, very cheap, and you think, right, I'm going to buy it. and you do buy it, but you find that it was cheap for a reason, and the share price does not recover in any sensible time frame, and in fact, maybe business gets worse, maybe the company ends up going bankrupt, and so on. And value traps are really the bane of all value investors' worlds. And that really is a core problem in value investing, is minimizing the number of value traps that you hold. And I would say that the way to avoid value traps, our very simple framework is we assess at Stockopedia, we rank the market for quality, value, and momentum. And I always say that value traps are very cheap stocks. They have a cheap valuation, but their current quality is very low. So they're often loss-making and their quality is very low. And they have no momentum. So often you have the brokers downgrading the earnings forecasts, the share prices at lows. And like I was saying earlier, the best time to invest in cheap shares is when there's a catalyst. And you can spot a catalyst often when brokers are upgrading their numbers and the upgrade cycle starts coming in and things start looking better. So, for example, we've seen that in quite a range of sectors, or even I could pick out company names where things sort of turn. They get very, very cheap, but then things start turning. And I will give an example like Currys this year, which everybody knows. That stock got very, very cheap. It looked like a value trap, but then the strategy starts working, and brokers start upgrading the numbers, and the share price starts recovering. And it's been one of the sort of really strong winner year to date. So I always like to see the momentum change, the earnings momentum changing or the price changing, or I like to see that the quality is still there. So a company still has good margins and good profitability. Without quality or without momentum, if a company is just cheap, I would always avoid it. You need something that's either a catalyst or the kind of resilience and the profitability.
Now, if you're looking at value, presumably you don't just use one measure, you use multiple measures, just in case one of them is misleading. And of course, for different sectors, different valuation measures might be more or less appropriate.
Yeah, that's absolutely true. I think, that Ben Graham was the father of value investing, and he loved to look for companies that sold at less than liquidation value. But I think in this kind of world of fairly efficient markets, if a company is selling for less than liquidation value, often something's gone quite wrong. So he would often look at price to tangible book as a kind of geeky kind of valuation measure. But these days, companies have got so much in intangibles, whether it's brand value or other sort of elements, that tangible book value is often not quite as important as it was. So, yes. And actually, one thing we found is that looking at value across a range of different approaches, looking at the share price or the market capitalization against its earnings or its sales or its dividends, you get a more blended view of the company, and that actually de-risks it. And the other thing is, if you just use one valuation ratio, like the PE ratio, it can often go out of fashion for years. And this is a surprising thing. I think in the 90s, companies in America and the whole dot-com boom, companies didn't have any earnings. So PE ratio was kind of thrown out the window. And then they said, okay, well, look, let's value them against sales, because at least if it's got sales. So they used the price to sales ratio, and that became really popular.
And right at the peak of the bubble, you got like price to total addressable market.
Exactly.
Don't even need sales.
No. And then, of course, when a bear market comes, they suddenly start scrambling around and they're like, well, we need something like cash. We need real cash flow. And then price to cash flow becomes really important again, or dividends become important again. So, but these things can happen. They go out of favor for a big period. And you don't want to become wedded to one lens or one way of trying to value a share.
Well, thanks so much for joining us, Ed. I've been using Stockopedia for a while now, and I really like the app. I think it really boils down a lot of the fundamentals into 3 digestible numbers that I can act on. So, thank you for creating the app. I really appreciate it.
Oh, thanks.
And thanks for joining us again. It's been a fantastic conversation, and it certainly made me a little bit more bullish on the UK. I'm a natural skeptic, but maybe I will up my allocation. Roman, do you want to ring the bell for the end?
Thanks, guys. Great to talk to you again.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.